It's been a very obviously chaotic, but frankly encouraging couple of weeks, even despite some key on-off ramps for crypto being, taken out effectively of our, current financial system makeup. We've obviously long treated Bitcoin as this liquidity sink. Obviously, if liquidity conditions are becoming more favorable, Bitcoin will outperform, it is most likely. And it's why we've been rather constructive on crypto, the asset class overall this year. Some interesting themes were brought to the forefront, particularly last weekend. For the first time in a while, we've started to see people really recalibrate counterparty risk. And counterparty risk as it pertains to both custody and transaction rails. So Tom had alluded to earlier, he mentioned, we're kind of in this regime where, with the internet and fintech apps and what have you, money isn't as sticky as it used to be. And in a world where money isn't sticky, then liability-based money inherently becomes riskier. Similar to deposits, right, in a bank, USDC, which we saw start to break the buck last weekend. USDC retains its value because it's able to be redeemed for $1. And when it was found out that Circle, the issuing company behind USDC, had some of its treasuries that backed the USDC in SVB, obviously USDC sold off. And interestingly, we saw Bitcoin pump. It caught a pretty significant bid. Very interesting. For the longest time, Tether has been cited as this, key risk in crypto. If Tether goes down, the whole crypto infrastructure will fall, Bitcoin will go to zero. But I think last weekend pretty much proves that that is not the case. And those within the crypto native economy view Bitcoin as this asset that is free of counterparty risk, right? Because it's not backed by any liability. If you custody Bitcoin, you own that. It's a digital bearer asset. And so that was very encouraging to see. That theme is going to start to leak into the broader economy. By and large, we've seen Bitcoin correlated to the Qs because, tech stocks have done well, earnings have been sound, growth has been sound. But there was a period Monday morning, Bitcoin and gold were pumping considerably while, traditional risk assets were not doing all that great. In fact, over the past month, correlations with gold have outpaced Bitcoin's correlations with tech stocks. And so, I think over time, this is more of a long-term theme to keep an eye on, is that there's going to be a cohort of investors that obviously still view Bitcoin as this risk-on beta to tech stock investment. But over time, I think, given the recalibration around counterparty risk, we're going to see more people treat Bitcoin as this, macro insurance. Right? Insurance on transaction rails and asset custody. So it's been a rather encouraging couple of weeks here.
Great, Sean. And yeah, I might just want to sort of agree with Sean's point, which is, Bitcoin, think about it, they lost 3 pretty important on-ramps, Silvergate, Silicon Valley Bank, and Signature. And as you can see on this chart, Bitcoin is well above its 200-day moving average of 19,000. And I think it really does speak to the resiliency of the Bitcoin network to actually see the support from its users despite losing that on-ramp.